Our third panelist today is a fellow named Brian Mayer. Brian Mayer is now with Wells Fargo, but in his previous employments, he's been involved with deals with 24-Hour Fitness, Lifetime Fitness, and even Equinox. He's talked about some of the trends he's seen recently, including the increased number of the high-volume, low-price clubs. We now have a label for it, HV/LP, high-volume, low-price clubs, or $10 a month clubs. He's seen an increase in franchisees. And this includes franchisees in other countries in addition to the U.S., including Canada. He's seen a focus now on ancillary revenue more than before, so that people can get more revenue per existing member. And he's seen the importance of internet technology going forward. He sees also potential future consolidation, clubs buying other clubs, not just financial firms buying club companies. And he thinks the social media and technology mix will add value to the member experience. He obviously reminds us all that obesity is a global problem, and so we all need to figure out how we can play in that space and make a difference to our local communities. When he looked at the three key deals that were done this year, this past year, one was obviously LA Fitness buying 171 Bally's in a number of different markets. That was a very significant one for every reason, including the size. Second was Lifetime Fitness buying some clubs from Lifestyle Family Fitness in 3 cities, Columbus, Ohio, Indianapolis, Indiana, and in North Carolina. And in all cases, they were areas in which Lifestyle Family Fitness had clubs, but they were getting back to their core in Florida, so they sold them. And what was interesting is Lifetime Fitness bought 20 clubs, but 2 of them they sold to one of the principals at Lifestyle, personally, to Jeff Dyer, who many of us know in the industry, and 9 they closed. So of the 20, only 9 remain open, and it'll be interesting to see how they configure much smaller clubs to be like a Lifetime Fitness, and what they do both in terms of physical plan and programming going forward. The third deal was Equinox buying 4 clubs, Sports Club LA clubs, from a public company called Sports Club Company. And what's interesting is that obviously Equinox focuses on the upscale, high service space, and they bought 4 clubs in the same space. And so it'll be interesting to see how they reconfigure them and how they make them more into the Equinox brand. They've changed the name already for those 4 clubs to Equinox and sold off the rights of Sports Club LA to others. Some of Brian's other conclusions are that debt is cheap, equipment financing is more readily available, that it's still an extremely fragmented industry, and everyone keeps telling me from the financial community it's one of the most fragmented industries they've ever seen. And for a lot of reasons, the new business models continue to evolve, from studio models, including group cycling only, obviously Pilates and yoga only, personal training only, as well as others of that type. And then the fourth panelist today is a fellow named Mark Harms, and he is the CEO of Global Leisure Partners. Because they're based in the UK, you understand why I said leisure rather than leisure. He's been in the industry a long time, and he's been personally involved, his company, with the 2 largest deals done in the UK, or with UK companies, including around the world. One is Fitness First, which is in Europe, Asia, and Australia, and the other is Virgin Active, which was recently sold its majority interest to a private equity firm. Mark tried to identify the lessons learned that he's learned over the years in working with the club industry, and he had several things I think were of note. One is that entrepreneurial founders may not always be right for future growth. If a private equity firm wanted to have very fast growth, in many cases they may not be the right fit for the future company. In addition, if management change was needed, he recommended it be done quickly and early in the relationship. He highlighted that private equity firms need to remind themselves not to overpay for value and not to over-leverage with their debt opportunities. The fitness business, he pointed out, is not recession-proof, but we've tried to define it as recession-resilient in the past. The barriers to entry for clubs is still very low. He talked about the fact that as a membership business, the focus in many cases has been too much around sales, and we now know it has to do with sales and customer service and product differentiation and some other attributes. He thinks the industry is still weak in data capture, and for many outside financial firms, that's one of their constant criticisms. The question he asked out loud is, will the incursion of low-priced competitors be significant? Will it hold its own over time, or will it even survive? He doesn't know, but he thinks it's too new for anyone to draw any conclusions as to what the future impact will be. And what he also highlights is that the number of major businesses, he believes over time, mainly the next 12 to 18 months, will change hands, and one or more may even go public. So he is buoyant that there will be some transactions of a major import involving the industry.